Welcome back to the Michael Yardney podcast. Today we're going to discuss a question that haunts many investors. When should you sell an underperforming investment? I know a lot of people who invested in Melbourne have felt that their investments have underperformed for a while, and it's a dilemma that can make or break your investment strategy. So today I'm joined by Stuart Wemyss, Director of ProSolution Private Clients, who's a seasoned financial advisor, author, and whose insights have guided many people through the choppy waters of investment decisions. And together we're going to explore all those emotional traps that could cloud your judgment and strategic considerations like tax implications, whether you sell or don't sell. So once again, welcome to another episode of the Michael Yardney podcast, where we help investors gain clarity amongst the confusion of the many mixed messages regarding property investments so they can develop financial freedom through property investment and smart money management. So, how do you know when to wait it out or when it's time to cut your losses and move on? Let's get on with the show and find out.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Stuart, welcome back again to the podcast. I love getting your blogs and your podcasts every Wednesday. And recently you hit on a nerve that a lot of people are thinking about, Stuart, about when should you sell an underperforming investment property? A lot of people are currently thinking about that with some market segments, in particular Melbourne, that has underperformed, Stuart.
Yeah, I think it's a really common situation, Michael, because returns aren't always straight line. And if you're lucky enough to invest just before a growth cycle, then of course, within a relatively short period of time, you're going to enjoy some really strong returns. And particularly for new investors, if it's their first property, it gives them a big sense of comfort that they've made the right decision and they're off to the races in terms of building wealth and all things are great. But unfortunately, if you mess up the timing or you're just unlucky with the timing and you buy just before a flat cycle, or even worse, you buy at the peak of the market and the market sort of comes off a little bit, then you could find yourself in a situation where you've held a property for 5 to 10 years and you've not seen a very substantial change in its value and maybe not even on its income profile. And in that situation, that creates the reverse. It makes people feel very uncomfortable with the investment. They feel like they've done the hard yards, but they actually haven't reaped the results. And we're always taught to be really critical and make emotionless decisions with money. And so we're taught to make sure, what are the returns? What are the fees? Or ask all these questions. And sometimes people sort of interpret that to mean that, look, if you're not going to get the perfect returns, after even a relatively short period of time, you should cut your losses and move on. So I think it's a really difficult decision to work out, like, if you've got an investment that hasn't performed, whether you should hold or whether you should sell and move on.
Well, there's those psychological biases. You've spent a lot of time, money, effort, and to be blunt, also a bit of pride in getting your investments. And so it's hard to be subjective about it. But in your blog, you quoted the famous Charlie Munger, the legendary investor, who famously said, "The big money is not in the buying and the selling, but the waiting."
And hasn't Berkshire Hathaway proved that yet again with their massive pile of cash that they're sitting on that they haven't yet deployed? I guess the answer there is in compounding capital growth. That over time, there's nothing that's going to beat compounding capital growth, but we know that it's just not uniform, or at least in many situations and many asset classes, including the share market, it's not uniform. And so if you can hold an asset for a decade and not receive much of a return, but hold it for 3 decades and you'll be, the results will be extraordinary just because you've been able to ride out those market cycles. So that's true. But the flip side is if you've got a dud asset, of course, it's just not going to work. So it's the quality of the asset will determine your returns over the long term. And you just can't realistically expect good quality returns from a poor quality asset. So on one hand, Charlie Munger's right. You've got to wait it out. But of course, the caveat there is that it's a good asset to begin with.
Sure, we've often spoken about quality rather than quantity. So, okay, let's start off with, how do you define an underperforming investment?
I mean, it's a great question. How do we benchmark returns? Because there's a lot of data out there. I can look at suburb data. I can look at capital city data. I can look at dwellings data or unit or house price data. I need to be really careful about how I do benchmark returns. I think just looking generally at house prices over a very long period of time is a good benchmark to go off. Now, if I've invested in an apartment, not a house, it's possible, and let's talk about investment grade apartments. It's possible that they won't perform as strongly as houses because they just don't have the same land value component, but it's still a relatively good benchmark anyway. And so if you have a look at house price growth since the 80s, so it's sort of 4.5 decades worth of data there, it's around about 7%. That's been the long-term capital growth rate, and the average inflation rate over that period of time is about 2.5%. So it's really 4.5% plus inflation I should be aiming for if I'm a property investor, and maybe slightly less than that. So 3.5 to 4% if it's an apartment. And if it's an entry level apartment, maybe another 0.5% less again. So a 1 bedroom, $500,000, old style type of apartment. I think they're pretty good rough benchmarks to use, Michael. But again, the big caveat here is that's 45 years of data. And in each of those markets, we've seen periods where, that they've experienced a long flat cycle and periods where they've experienced a growth cycle as well. So you've got to be careful about, how you're benchmarking, because if you're benchmarking in a location that has been in a long flat cycle for a period of time, like a couple of years ago, Perth was in that very position,
Yes.
then you'd be disappointed. So it's got to be relative performance relative to the location that property is in.
All investment classes go through cycles. They don't have a straight upward line. So I think that's maybe a starting point to discuss, to understand the fundamentals.
Yeah, so I mean, if we think about property, and we've talked about this before on this podcast, I've done a lot of research around how property in our capital city markets goes through two distinct cycles, which I've already sort of touched on, being a flat cycle where prices don't change very much, and those flat cycles tend to last for 7 to 9 years, and you can get no real growth in terms of relative to inflation, so really just growing at 2 or so percent. And then there's growth cycles, and those growth cycles tend to last for about 10 years. And over growth cycles, the median house price triples over that time. So it's very strong growth. Now, if you put a flat cycle and a growth cycle together, you get an average compounding rate of about 7%, which is that sort of long-term average. So, of course, properties are going to go through a growth cycle, which is really an expansion cycle. That's when everyone thinks property prices are going to rise forever. We better get into the market because the prices are never going to go down. That sort of mentality or sentiment, I guess. At some point, property becomes overheated, so it tends to go a little bit too far. It might have a small correction. And when I say small correction, we're talking only a couple of percent. And then it'll go into a flat cycle. So a bit of a downturn where sentiment really changes. Property transactions tend to fall. The good properties never really transact in those sort of markets. And then sentiment will eventually change into a positive direction as well. And then that's when we see sort of green shoots of growth, which potentially, I mean, it's only early days yet, we might have seen in the February data in Melbourne.
Yes.
So, and then it'll head into another growth cycle. So it's really important to understand, if I own a property in Brisbane, for instance, and I need to be benchmarking my growth because I know from the beginning of 2018 that Brisbane market really started to move. But it's quite possible if I bought in 2008, I might not have seen much growth between 2008 and 2018 because that market was pretty stagnant during that period of time. So benchmarking is important, but you've got to benchmark it relative to the general market conditions for the
So let's
locality.
make it clear, there's not one Australian property market. Now, you mentioned Brisbane. There's not one Brisbane market either. But in general, states' property markets performs overall much the same. So you're talking about Brisbane having a flat 10-year cycle. Perth did. Melbourne's experienced it now too. So each state does that over time, and in different factors to a different timing to other states. And it has a lot to do with economic confidence and economic growth in that particular state, Stuart.
Yeah, and sentiment is a big factor
Huge,
too. So you
huge
can
factor.
have fundamentally the economy is relatively sound, but sentiment is really negative, and as a result, in the short term, sentiment will drive those short term results. You're right, and of course, no one wants to be in a situation where they've bought just before a flat cycle. But and you talked about the psychology of it. You know, if you're going to end up buying an asset at the wrong time, you might feel like a bit of an idiot for doing that. But the problem is, if you react to that, you might be ending up throwing the baby out with the bathwater. In that, if you've already done those hard yards, you bought at the beginning of a flat cycle, you've ridden that flat cycle for 10 years. We don't want to just sell it potentially before you hit another growth cycle, because you'll look back in 10 years' time and kick yourself. So that's why
How often have we seen that happen? So I guess the first thing you should ask yourself, honestly, is this investment fundamentally sound? In other words, have I got an investment grade asset?
Yeah, that's right. And that's the most important thing, because fundamentals at the end of the day will drive your long-term returns. The problem is that no one knows how long markets can be in a flat cycle for and how long markets can last through a growth cycle. And quite often, in many situations, they've lasted longer than, in both those situations, longer than any rational person could have anticipated.
Mm.
So you do have to have that patience, which is what Charlie Munger was talking about in his quote, in terms of patience to sort of ride out those cycles. But if you return to your original investment decision and look at the attributes of the property that you're investing in terms of, you know, how much land value is there in that asset? Is that land located in a location that benefits from excessive demand and will continue to benefit from excessive demand? Is there some sort of uniqueness with the property? You know, haven't just bought in a tower with 300 other apartments just like it, for instance. So you've got to think about then the fundamentals. You can take it one step further, Michael, and look at the fundamentals in other types of property categories. So, for example, if I'm looking at older style apartments in Melbourne, for instance, and this apartment block is located in Paran, which is an inner city suburb of Melbourne, an investment grade inner city suburb, it's very obvious if I'm tracking house price sales that the underlying land value in that location has changed, has certainly appreciated by a lot over the last 10 years. But those apartment stock, the apartment prices for those older style apartments just really haven't changed very much over that period of time. So we're then going to look and do a bit of a fundamental analysis, ask ourselves what's going on. Because the building value is not going to change very much. They're older style, they were built 60, 70, 80 years ago. They've depreciated. They're probably not changing much from here on in. So it's really the land value. So either two things are true. That land is still the same value for some reason, even though it's located in the same suburb, or it's a market sentiment issue. It's just this category of asset just isn't loved yet by buyers, or at least not loved as much by buyers of houses versus apartments. And so by doing that fundamental analysis, you can return back to your original investment decision and ask yourself, putting aside the market's performance, would have you bought that asset? At that time when you bought that asset, knowing what you know today, was that a mistake? Except for the fact that, you know, you've caught it in the wrong cycle. And if the investment decision, the original investment decision, was fundamentally sound, then I would just refer you back to Charlie Munger's advice, which is the money's in the waiting.
Well, as you say, if it's fundamentally sound, the best holding period is forever, as Charlie Munger and Warren Buffett say. And some investments just take time, like those who bought the Melbourne apartments in the first part of last decade. They haven't gone up much at all. I know you hold apartments, I do. We both hold blocks of apartments, but they're now so much below replacement value. We have to be patient to wait because they're going to pick up again. But how long can one wait? Because emotions get in the way. How long should you wait?
As long as you possibly can is the answer. I remember appearing on a TV show. It's probably about sort of 10, 15 years ago now. And the panel was just having a chat. And this very well-known guy in property was saying he just sold a commercial property. He'd owned that property for 20 years, sorry. For the first 18 years, it did absolutely nothing. And he doubled his money in the last 2 years of holding it. And I remember that conversation perfectly well because it really imposed on me the fact that you really do just have to hang in there. If they're fundamentally sound, if you've made the right decision, all markets will revert to the mean return at some point. And particularly when you've got the fundamentals, like you said, replacement cost is much lower. You know, it costs us, well, developers are saying 30 or 40% to build apartments these days compared to pre-COVID. And the underlying land value, we know from transactions, and even transactions where blocks of whole apartments have sold, we know the underlying land value is certainly increased. So it just doesn't make sense. And in that situation, you've just got to kind of ride it out. I mean, it happens in all asset classes. You know, the US has had a stellar sort of 10 or 15 years most recently, but if we cast our mind back to the period, the 12-year period between year 2000 and 2012, the US stock market did absolutely nothing. You would have picked up the dividend yield, which is maybe about 2%. But in terms of the index value, it really just jumped around, didn't change for that whole 12-year period. So here I am investing in the greatest or the largest developed economy in the world, and I've got zero returns for 12 years. Well, if you had a sold in 2012, you would have kicked yourself, of course, because since then, over that period of time, we've had double-digit returns, sort of 12 or 13% compounding. So if you look at that whole period, that whole 25-year period since year 2000, the average return is about 8%, which is kind of in line with the long-term average. So if you were an investor and you rode out that 25-year period, you should pat yourself on the back. You've done pretty well. But if you lost faith 12 years into that journey when you had zero returns, you've really missed the boat. I wanted to use that as an example because particularly in the backdrop of the last 5 years where the stock market has performed really well and the property market in Australia has been relatively patchy. It's done well in some locations, but it has overall been relatively patchy. It's a good example to draw because just to remind people that all asset classes go through these periods of time where the returns are well below the average, but those periods are always followed by periods where returns are well above average. And as I said, I looked at every single growth cycle since 1980, and the average change in price is a tripling of price over that 10-year growth period, which sounds extraordinary. And I guess, those percentage returns won't necessarily continue into perpetuity because in dollar value terms, it doesn't make a lot of sense. But I think what we can draw from that is it's a substantial price increase in a relatively short period of time.
Now, over the boom that we experienced after COVID and very low interest rates, almost any property you bought would have done well. You could have bought the worst house on a main road, really near a major corner, it would have gone up in value. But sometimes one makes the wrong investment decisions. So I understand that what you were talking about up till now, Stuart, is if your initial decision was fundamentally sound. But what if on reflection you decide, hey, maybe I did buy the wrong asset? What do you do then?
Well, you've got to, I mean, I don't know if there's any hard or fast rules here, Michael, because it really does depend on individual circumstances. But I think firstly, it's a brave decision to recognize, past mistakes. And, the saying goes, if you find yourself digging a hole, stop digging. And it's really true, but it's sometimes difficult to do. So I think reflecting back on that past decision, if you can conclude, hey, it's not something that I'd ever do again today, there's a lot of power in that. Then it's just about deciding what to do.
If I could interrupt for a sec, a question I often ask clients, well, I used to when I saw them, I now only look after a small group of clients, was knowing what you know now, would you buy that property again today? And if they say no, I'd be blunt enough to ask, well, why are you still holding it? Because then I bring up concepts like opportunity cost.
Yeah, absolutely right. And it's a perfect question to ask yourself. Now, I guess the first question then is to say, okay, well, if this asset is not a great asset, then to my mind, there's never a bad time to buy a great asset. And the flip side of that is there's never a bad time to sell a bad asset. Having said that, though, you want to make sure that you strategically exit from that asset in a way that's going to maximize your exit price. So once you decide that asset is not a great asset, the next question then is, when should I sell it? Now, if that asset is in a market that's sort of a little bit depressed, a bit difficult, you might actually be better off just holding on to it for another 1 or 2 years and then just strategically divesting of that asset when the market picks up. So I think we need to think about how the market's doing relative to the asset. You might not have the time to do that. And that's one thing is that you can never replace is the amount of time that you have in the market. So you need to consider that as well. Like you don't have too much of a runway before you need to get to retirement. You might not be able to wait out another 5 years. So you need to really think about that. Sometimes I find that assets fall into 3 categories, Michael. They're either really terrible, they're obviously terrible, there's no question about it, it's a dud asset, we should sell it tomorrow. Sometimes we look at it and we go, well, this is a fundamentally sound asset, despite its performance, it's a fundamentally sound asset, it's fine. But quite often it can be in the middle of those 2 points where you go, well, it's got some impairments, it's not perfect, but it's not absolutely terrible either. In those situations, what I like to do, if it's possible, is to hang on to that asset and just replace it. So buy the replacement asset today, but hang on to that asset just until you build a little bit more data around it. So that is that if I had a client that held an apartment, I thought it had some good attributes, it wasn't terrible, but it's not the thing that I would buy today, I would say, let's keep the apartment and let's just watch it. Let's see, keep a close eye on in terms of its performance, and let's go and buy an investment grade house. That way we know that if the apartment doesn't work out, it's fine. We've already made the replacement investment, but it gives us a little bit more time to build a little bit more data set, because the problem with selling property generally, and I don't want to talk people out of it because if it's a real dud, you should sell it. But the problem with selling property is that prices tend to trend higher just as a general observation. And so it's really easy to look like an idiot in time. You know, you go and sell a property today, and in 10 years' time, you look back and go, oh, look at that, it's doubled again. So we're always really conservative about that. If we're going to sell something, and we'll sell it with confidence. But if we don't have that full confidence, we try and replace the asset already and then just build a little bit more data around it. And if you're getting, if you're not getting your 7% growth, but you're getting 5.5%, actually, when you do the numbers, it might not be worth selling. It might be worth just hanging in there for another growth cycle and then divesting of it when you're in retirement. You don't have to pay as much capital gains tax, for instance. So it really does depend on individual circumstances.
Well, I know at Pro Solution Private Clients, you give holistic advice to clients, and you are an accountant by degree, but you give financial planning and mortgage advice. So how much do tax considerations come into play when deciding to sell an underperforming property? I mean, people pick that up. I don't want to pay capital gains tax, but I am paying land tax. And it seems to be a major factor in their minds, Stuart.
Yeah, it is. And it muddies the waters, and it can make it a difficult decision. It can make it a difficult decision for professionals. And we're not emotionally invested. Like, the capital gains tax isn't coming out of our pocket, but it's still it's something that can invite you to make a mistake. So anyone that sort of follows the share market would know that CSL, which is, a major stock on the ASX,
Yes.
has been a stellar performer since it listed, I think, in the 80s in terms of returns to investors, but hasn't done anything for 5 years. And we come across clients quite regularly where they might have bought CSL many, many years ago, sitting on a huge capital gain. And they're like, well, we don't want to sell the stock because we'll trigger capital gains. But for the last 5 years, they haven't earned a return. I'm not picking on CSL. It might recover and it might still be a good long-term performer, but it's just an example of where we let a potential liability, or not a potential, it's a liability, invite us to continue to repeat the same mistake that we made last year, which is to hang on to a dud asset. So look, I think it's got to be in context. If there's an opportunity to materially minimize capital gains tax in the near term, so I'm going to retire in 2 years' time, you might take that opportunity. But if we're many years away from retirement, look, sometimes just better off taking the hit, paying the capital gains tax and moving on, and putting that equity and cash flow in an asset that's going to generate much better returns in the long run. But I acknowledge it's something that you must consider and you must weigh up, but just make sure it doesn't overly influence your decision making.
Makes sense. So in your blog, which I'm going to leave a link to, you quoted American billionaire and fund manager Monish Pabry, who once said, the single most important skill of being a good investor is to be very content with not doing anything for extended periods of time. I guess what you're saying is doing nothing doesn't actually mean being inactive, rather be patient and keep a track of how things are going, especially if your initial decision was fundamentally sound.
Yeah, I think the best investors do nothing. There was this study, and it's apparently a bit of a story, but it's still a good story nonetheless, that a fund manager in the US did a study of all their best performing accounts. And the best performing accounts they highlighted were people that had passed away.
I've heard that joke,
Yeah,
yes, or the
yeah.
story, yes.
Yeah, apparently it's not true, but I mean, it's a good story nonetheless. And I think it's true that, really seasoned investors, and that's why I said at the beginning, it's really difficult for first time investors to ride out a flat period, particularly if it's their first investment. But a seasoned investor doesn't seem to have nearly half the trouble, just because they know how it all works. They've seen it work, they've experienced, they're happy with it. And look, I think when you're younger, you have probably more impatience. You want to get there quicker and sooner. And no one has any appetite for zero return. So I'm not
No.
advocating or suggesting it's a completely satisfactory outcome to have zero returns for the first decade of owning an asset. Sometimes, though, it's just unavoidable, and sometimes you can't anticipate these things. But really, doing nothing tends to be the best thing to do. People think these days around, what should I do with my investments if now that Trump's in power, or what should I do if the RBA is going to cut interest rates, or all these sorts of things. Quite often, the answer is absolutely nothing. Just stick to your plan.
So the conclusion is sometimes the right thing to do is nothing. Now, I said at the beginning of our chat today that I enjoy getting your blogs and your podcasts. What does your team at Pro Solution Private Clients do? For those who don't know you from our regular chats, you've been a regular guest for quite a number of years, but there's always new listeners, and sometimes it wasn't relevant to them at the time.
Yeah, sure, Michael. So we work with clients on a holistic basis, which means we have a multifaceted team of accountants, mortgage brokers, and financial advisors that all sit around the table, develop a long-term strategy for our clients and help them execute it. And by having all those heads all around the one table means that we make sure that we optimize everything from tax to cash flow to mortgage broking structures, and ultimately exit on the long-term plan that we've already formulated. And we think that's really the best approach that harnesses the most amount of value.
Leave a link to Pro Solution Private Clients in the show notes, as well as to your books and your blog. Stuart, thanks for giving us that advice, because as the market now is going to improve later this year as interest rates keep falling and people realise inflation's under control, there are still going to be segments of the market that are underperforming. But I guess the conclusion is be patient, but also get advice, because it's too hard for most of us to be objective about our investment. Look forward to catching up with you next month, I should say, Stuart.
Thanks, Michael. Cheers.
As always, I had fun having a chat with Stuart Wemyss and giving you some insights into making that important decision about when to buy, when to sell, should you sell at all. Now, having said that, in a moment I'm going to share my mindset message with you, but if you excuse me, I want to remind you about Wealth Retreat 2025. It's just around the corner, and I'd like to point out it's decision time, because Wealth Retreat starts at the beginning of May on the Gold Coast. It's not too late. There's a couple of spots left. And the message I'd like to give you today is that life's short and procrastination is the thief of dreams. So it's important to make good decisions quickly and leverage your most precious resource, your time. Property investment lets you use both financial and time leverage to acquire streams of passive income. So in the future, you won't have to trade time for dollars. Do the work on one deal once, and then over the years, you're going to reap the reward of capital growth and cash flow. Build a big enough property portfolio of the right type of assets, and that's what this podcast is about. Then over time, your wealth will eventually lead to passive residual income. It's a great formula. But there's a way that you can get there faster, and that is to join us at Wealth Retreat 2025 between May the 3rd and the 7th. When you join us, will help you create your future and help you make the next 5 years the best 5 years of your life. That's the theme of Wealth Retreat. Why not go to wealthretreat.com.au, I'll leave a link in the show notes, and find out about it and register your interest. Don't count yourself out. By the way, it's an invitation-only event, so we always speak with you to make sure it's appropriate for you and you get benefit from it. But it was specifically designed so that you not only get a concentrated version of everything we know about property, tax, finance, property development and business from our faculty, but you also have the opportunity to network with a group of successful movers and shakers. And the result is that you go home with a holistic plan for the next 5 years of your life, not just in property and wealth, but in 7 areas of your life. And I always have a one-on-one implementation session with everybody who comes to Wealth Retreat to make sure that you know what to keep doing, know what to stop doing, and know what you should start doing new things. So you're going to get breakthroughs, you're going to have a community, not be isolated, and you're going to have the ability to, because it's a small group, spend time one-on-one with all the experts. It could be the breakthrough you're waiting for. Time is running out to register for, excuse me calling it, a life-changing event. If you miss out, you're going to have to wait another whole 12 months for the next one. That's an entire year of lost opportunity. So go to wealthretreat.com.au, find out what you're going to miss if you don't attend, and please register your interest. Now is decision time.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message today, I'd like to remind you that the longer it takes, the longer it will last. I've read that the average red oak tree takes 15 to 20 years to produce its first acorn, but it will then produce acorns for up to 350 years before it dies. Conversely, a cherry tree takes about 4 years to produce the first sweet cherries, but its longevity is short-lived. It'll produce cherries for only about 20 years before it dies. Becoming wealthy, like the mighty red oak, takes a long time. That may not be what you want to hear, and I clearly know it's not what a lot of people are going to tell you on social media, but over the years I've realized that the path to becoming wealthy is a long journey. To become financially successful in residential real estate investing can for many people take up to 30 years. Now, there are some shortcuts to make it safer and secure a little bit faster, but it's going to take a couple of property cycles and decades. Most wealthy people I come across understand how hard it was to accumulate wealth. Because of this smart money mindset, they intend their wealth to be created during their lifetime, but also to live on long after they were dead, benefiting their children, grandchildren, and great-grandchildren. So these smart strategic investors saw their wealth as an opportunity to benefit many future generations. It was their legacy. Conversely, you've heard it, you've read it before too, about 70% of all lottery winners go broke within a few years. Easy come, easy go. Because they didn't work on building their wealth over many years, their wealth really had little value to them other than spending it or giving it away to friends and family. So if your goal is to become wealthy and keep that wealth within your family, my mindset message to you today is you must build a solid foundation forged with smart money habits, forged over many years, which can then be passed on to future generations. Building a foundation like this, that takes time, but the longer it takes, the more sound the foundation will be. So I ask you, which tree do you want to be? A cherry tree or the red oak tree? Thank you for spending the last little while with me. I hope you got some benefit from this show. But before you move on to the next podcast you're going to listen to, let me remind you I have another show that I produce once a week with leading demographer Simon Kirstenmacher. We call that Demographics Decoded, where Simon and I unveil the trends that are going to shape your future. In my mind, this is a must-listen to podcast for anyone interested in property investment, but also for business people and entrepreneurs. So if you don't currently subscribe to Demographics Decoded, just please stop for a second and subscribe on your podcast app where you're listening to this, or on YouTube. And of course, if you don't subscribe to this show, the Michael Yardney Podcast, why not click the link that says follow or subscribe wherever you're listening right now. So twice a week, you're going to get benefit from my guests and me. Oh, and I'd like to ask you a little favour, please. If you did enjoy today's show and you know somebody who would also benefit, please tell them about the Michael Yardney podcast and Demographics Decoded. There's a share button on every podcast app. On Apple Podcasts, there are 3 little buttons at the top of the player. Well, just tell them about it. Just have a chat with them. Now, I hope you're going to be doing them a favour, and you're definitely going to be doing me a favour in my quest to help as many people as possible to become financially literate. And by the way, I've got a special bonus for you. As my way of saying thank you for subscribing, just go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where I've got a bunch of ebooks and reports. It's just my way of saying thank you for taking the time to listen. And remember, the information that we give you in this podcast is general information, not specific information about your personal circumstances, because we don't know about them. But if you do want specific information, you can always have a chat with my team at Metropole. Go to metropole.com.au. If you really want to learn more, you can always listen to the previous podcast, the many episodes we've already published. Just go back to the old episodes, which each have lessons about property investment, success, and money. Once again, thanks for listening to today's show.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favorite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael, but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?